ดีค่ะยินดีต้อนรับสู่การนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนนะคะหรือ PSL โดยคุณคาลิดฮาชิมกรรมการผู้จัดการของเราจะอัปเดตในเรื่องของภาพรวมอุตสาหกรรมและตามด้วยคุณกอตัมสุรานากรรมการการเงินนะคะในเรื่องของผลประกอบการประจำปี 2025 นี้และถ้าท่านใดมีคำถามนะคะสามารถพิมพ์เข้ามาในระบบรอไว้ได้เลยนะคะค่ะขอเชิญคุณคาลิดค่ะ
Thank you, Som, and good afternoon, everyone. This slide shows you what's been happening in China. And if you look at the bar charts underneath, it tells you what has been the change between 2025 and 2024. If you look at the percentage changes, it's given on the top. And if you look at that, you can see quite clearly that China's coal imports have come down. Iron ore imports have actually gone up. Steel production has come down. And steel consumption has gone up dramatically. And steel exports have also done very, very well. At the same time, bauxite and alumina have been imported in very large lots. So overall, I think China has done a very good job for the dry bulk market. If you look at steel exports, first of all, crude steel output fell to a 7-year low at 961 million metric tons from the 1,000,000,005 million metric tons, which was there in 2024. Yet exports hit a record with strong growth, offsetting China's 4.4% contraction in the steel production. At the same time, in 2025, exports rose by 7.5% to 119 million metric tons. This is a new export record. If you look at the places that the steel exports were made to, despite the restrictions from European Union, Japan, and other countries, steel exports went mainly to the Middle East, Southeast Asia, and Latin America. 57% of China's steel in 2025 was exported on Supras and Ultras, 24.2% on Handys, 9.6% on smaller Handys, less than 20,000 deadweight, with the remaining 9.2% on Panamax and larger vessels. And what is the outlook for 2026? Exports are likely to remain elevated, despite all the anti-dumping rules that are taking place. If you look at China's iron ore imports, it reached a record high of 1.26 billion tons in 2025. It was up by 1.8% year over year. 2025 imports surged in the last month in December by 100 to up to 119.65 million metric tons. And it's the highest monthly volume on record. It was up by 8.2% month over month. It's not only the highest monthly volume on record for China for iron import, but it is also the highest monthly record for any country anywhere in the world for any commodity. So it just gives you an idea as to how large the imports in China are. Looking at the key drivers behind this elevated imports, what was it? What was driving that was strong domestic manufacturing activity, secure more offshore iron ore rather than use the very low quality iron ore in China, strong steel exports, and imported iron ore ensures operational efficiency for all the blast furnaces. In terms of outlook for supply and trade flows, global iron ore supply forecast is to grow by 2.5% in 2026. Shipments to China is expected to rise by 36 to 38 million tons in 2026. And global iron ore exports are projected at 1.8 billion metric tons, plus 1.9% year over year. Guinea's Simandou mines at 22.4 million metric tons, contributing to greater ton-mile demand, because each ton from Guinea is about 3.25 tons from 3.25 times that of Australia in terms of ton-mile demand. And Australia's exports are going to go up marginally to 930 million metric tons. Brazil's exports are going to be strong at 431 million metric tons, plus 3.3% year over year. So both the long distance or the large ton mile demand growth will come from Brazil and from Simandou mines from Guinea. So steel production in East Asia and Europe has declined. India has continued with strong output growth at 165 million metric tons for 2025. And the US has become the third largest player globally at 82 million metric tons. Now, you could notice that other than India, every other country which is number 2 or number 3 is less than the amount of steel that China exports in a year at 119 million metric tons. Steel output fell to 961 million metric tons in 2025. It's over 100 million metric tons down below the 2020 peak at 1.065 billion metric tons. China became the number 1 steel producer in 1996, while India rose to second place by 2018. US output rose by 3.1% year over year to 82 million metric tons. If you look at Japan's production, it fell by 4% year over year to a 57-year low at 80.7 million metric tons. Iron ore was down at 0.5% year over year to 959.13 million metric tons. That's the imports into Japan. It's the second largest importer of iron ore in the world after China. Soft demand in Germany and France, healthy demand in Spain, and the carbon border adjustment mechanism is likely to support domestic output and reduce imports into the European Union. Emerging market steel makers, who are they? Vietnam, Indonesia, Saudi Arabia, and Egypt. Together, they have gone from less than 9 million metric tons to above 40 million metric tons in 2025, with Vietnam at 11th place globally at 25 million metric tons. Combined iron ore imports by these 4 countries is nearing 60 million metric tons. So it's giving us a lot of support for minor bulk and iron ore trade growth. If you look at the types of ships that carry steel, it is mainly within the handy-size, Supramax, and Ultramaxes. If you look at the Guinea bauxite exports, China imported a total of 200.5 million metric tons of global imports of bauxite, of which 149 million metric tons came from Guinea, which was 74.3% of the total exports of Guinea. If you look at the US-China trade truce, what did it do? It suspended all countermeasures. America suspended all their USTR 301 rules that they had put out, and China suspended all countermeasures. As a result, US lowered fentanyl tariffs from 20% to 10% and suspended 24% of reciprocal tariffs. China's exports to US declined to USD $431.6 billion in 2025, and from $536 billion in 2024, a 19.5% decline. Despite that, China's trade surplus increased to $1.2 trillion. It's the highest ever recorded by any country in the world in terms of trade surplus. And China's pledged to buy more cargoes of grain from America. But if you look at the volumes of grain that they're pledged to buy, it is what they normally buy from America. So they're not pledged to buy any extra amount of grain from America. And of course, China has designed a new rare earth licensing regime to temporarily lift restrictions on rare earth trade. Dry bulk trade and tariff impacts in 2025, if any. China exported 209.3 million metric tons, or 3.8% of global dry bulk exports, mainly to East Asia, Southeast Asia, and Latin America, and some to the Middle East. The US accounted for just 1.8% of China's dry bulk exports, or just 3.68 million metric tons in 2025. In 2025, China imported 2.2 billion metric tons, 41% of total global dry bulk imports. European Union was second at 8.1%. India was third at 6.7%. Remember, European Union consists of 27 different countries, and that is all that they could muster on. between them. China, also in 2024, China imported 2.3 billion metric tons, again 41% of the global dry bulk imports at that. In that year again, in 2024 again, European Union was second at 7.9% and India was third at 6.8%. The third bullet point gives you all the different imports that China made. And if you look at the fourth bullet point, US exported just 1.1% of dry bulk goods to China, or just 24.54 million metric tons. And if you look at the breakdown of that, you can see that these are all fungible cargoes, i.e. they can be bought from any and many other countries. So therefore, tariffs only hurt US, not China. This slide just tells you that grain exports are going to grow by 40.8 million metric tons this year, or 6% year over year. And if you look at the minor bulk trade, it's going to grow by between 4.5% and 4.7% year over year. And then if you look at what are the drivers for this, you can see it's aggregates, limestone and others, cement, slag and fertilizers mainly. These are the ones which are going to increase. Ton-mile demand growth on larger vessels is going to grow by about 13% year over year. For geared ships, they'll grow by about 7% year over year. Now remember, this 13% is largely because of the Guinea exports of both bauxite and iron ore. Now, if you look at the three pie charts that are put down below for you, you can see clearly that the handysize and the supra and ultras carry the majority of all minor bulk cargoes. Yet you have this 10.7 wedge in orange, which is the Panamax, post-Panamax, which is growing to 13.1% of the pie chart. And you can see clearly Capes have been steady at 2.2%, which is mainly the bauxite from Guinea. If you look at this chart, it shows you how we have fared against the world average for the geared tonnage. And you can see that for agricultural products, we are at 1.2 times the world average. For steel cargoes, we are at 3.1 times the world average. And for fertilizers, we are at 2.3 times. And for wood products, we are at 2.4 times the world average. So you can see clearly where we have focused our energies on. If you look at this slide, it gives you the total order book being 12.24% in the dry bulk sector at the start of this year. And if you compare that with the old age fleet or fleet over 20 years of age, it is 11.26%, of which 3.75% is today even older than 25 years of age. If you were to compare the order book, which is all the way up to end of 2029, with the average age of the fleet at the end of 2029, if there was no scrapping, then you can see that you're going to be buying or getting brand new ships 11.26% as against 20.7%, which would have reached their end of life use a long time before that. If you look at this slide, it gives you what was happening before the big bull run, which took place in between 2004 and 2009. So you can see in this slide, you can see clearly that the forward order book was reasonably low and definitely lower than the amount of 20-year-old ships in the world fleet. If you look at this slide, it shows you that in between 2004 and say 2011, the big bull run ended in 2009. But let's look at this up to 2011, and you can see how crazy people went because of the bull run, and they thought it would never end. At the start of 2009, this was worth 78.14%. If you then look at this slide, it shows you what happened during the very bad years between 2012 and 2019 at the start of the, which was the start of the pandemic. And you can see clearly that the forward order book kept falling from a high of 38% at the start of 2012 down to 12% at the start of 2019. 2019. Now, if you look at 2020 to 2025, in these 6 years, what do you see? You see a very slow, gradual return to growth of the forward order book. At the same time, the 20-year-old fleet has kept climbing and is now just 1% below the forward order book. Now, if you again go back to this slide, you can see what happened here before the bull run, what happened during the bull run, what happened post the bull run, and now what do we see? We see a similar slide as what we saw when we were looking at the years 2000 to 2003. If you look at what happened during 2025, 162 million deadweight tons was ordered during 2023 to 2025. So in the 3 years, 162 million deadweight tons of ships were ordered. Against that, in the 2016 to 2022 period, just 149.1 million deadweight tons were ordered. Again, it can shows you how confidence has built up once the markets have improved. Ordering of during 2025 was 48.1 million deadweight ton and was below the 2024 levels with a sharp Q4 acceleration. So in Q4, the confidence level in dry bulk reached a very strong level, and therefore people did order more ships in Q4 than they did in the first 3 quarters. So if you look at the orders placed during Q4, it was 22.1 million deadweight ton, 46% of the total annual total. And then if you look at what was being ordered, very large old carriers went to 16% in 2025 compared to 1% in 2023. Capes share climbed to 39% from 19% in 2023. And VLOCs plus Capes accounted for 46% of the total 2025 contracting. If you look at these smaller ships, Panamax, post-Panamax fell to 25% from 39%. Supras and Ultras fell to 19% from 30%, and Handys remained broadly stable at 9%. The other thing that is reducing the supply side is special surveys. Now, if you look at that, Handysizes recorded the highest average daily number of 64 vessels undergoing special survey since the first half of 2022. This is on an everyday basis. 64 ships were stuck in dry dock somewhere or the other in the world throughout 2025. If you look at the average daily number of Supras, Ultras in conducting special surveys, they averaged 84 vessels every single day during 2025. The supply of geared vessels in 2024 experienced a 1.7% loss in supply just because of special surveys. And the estimate for 2025 is 2.2%. The same amount is expected in 2026, and then in 2027, it'll go to 2.4%. The supply impact is measured from the end of a vessel's previous laden voyage to its departure after completing special survey. Now, this slide shows you how EEXI, or existing energy efficiency of existing ships, is calculated. And what happens is that if you don't comply with your EEXI calculations, then you have to reduce your speed. Now, we have just taken a snapshot view of what happened to us when this rule was enforced at the start of 2024. And you can see that we had to reduce a total of 1.5 knot speed from our average speed during that when the EEXI was applied to us. Now, remember, our fleet in the start of 2024 was younger than the world average fleet, and yet we had to reduce speed by 1.5 knots. Now, if you apply that 1.5 knots to the entire world fleet that was built at between up to and including the end of 2011, then you will see that you will be affecting 13.18 million deadweight tons of ships. And this is resulting in a 3.4% contraction of the supply side. So roughly about 5.6%, including special surveys, would be the net reduction in supply that took place last year. Now, this is what we expect will happen coming into 2026, that you will have another 5.5% reduction. So what are the key industry takeaways? First of all, IMF has been increasing the GDP growth of the world consistently, and they're now at 3.3% for 2025 and a similar 3.3% for 2026. China's GDP growth rate was 5%, as the country had said they would be about 5%. It's hit exactly that number. Ton-mile demand is now forecast to increase by 1.8 to 2% in 2025 and 2026. And the momentum, which was there in the second half of 2025 for stronger growth in terms of iron ore, grain, and minor bulks, has continued. China's fixed asset investments has come down in 2025 and shrank by 3.8%. Yet, as you know, that they were able to export more steel, they imported more iron ore. Dry bulk fleet is estimated to grow at 3% in 2025, but net effective supply will tighten according to Clarkson due to lower speeds and congestion and off-hire and from special surveys. Lower speeds is from the EEXI. Net effective supply or loss of geared bulk fleet in 2025 is estimated at 2.2% due to special surveys and 3.4% due to EEXI speed reduction. So resulting in a combined 5.6% reduction in net fleet supply. Order book to fleet ratio at 12.24% as of 1st Jan is marginally larger than the 20-year-old fleet at 11.26. So then there's other disruptions. So we think that supply-demand balance will continue to improve. So what has been our strategy? So our strategy is around three things: reduce the fleet average age, increase the average deadweight tons of the ships, and reduce greenhouse gas emissions. Now, if you look at this slide and look at the box chart on the top, you can see that in 2014, though we had 38 ships, and in 2025, though we have exactly roughly the same amount of ships, the average grams of CO2 per ton mile of cargo carried in 2014 was 12.5 grams versus 5.55 grams in 2025. So we've reduced dramatically our carbon emissions compared to what we did in 2014. And this is mainly because of changing the fleet composition. So what did we do during this period of time? We sold 23 handy-sized ships, average size 25,274 per ship, and we sold 3 Supramaxes, 53,843 average per ship. And we sold these ships, which had a speed of 12 knots and 11 knots respectively, with a consumption of 19 tons and 27 tons, with an average grams of CO2 per ton mile of cargo carried of 17 grams for handy-size and 10 grams for Supras. Instead of that, we replaced it with 9 handy-sizes and 17 Ultramaxes, of which 4 are still to be delivered. The average deadweight size of the handy-sizes was 38,400, and the average size of the Ultramaxes was 64,000. The average speed of the handy-sizes that is 11 knots. The average speed of the Ultramaxes is 12 knots, and the average consumption is 18 tons and 20 tons. Against that, what is the average CII, or grams of CO2 per ton mile of cargo carried? For the new handy-sizes, 7 grams, and for the Ultras, 5 grams. So if you look at the comparison between the sold ships and the bought ships, you can see that we have strategically reduced our CO2 intensity by 59% for handy-size and 50% for Supras and Ultras. And this gives you a picture of the number of ships that we have and the average age. And you can see clearly the average age has now been frozen at roughly 11 years. And we hope to keep this average age like that. And values have gone up, of course, because of the new ships that have come into our books. And the average size per ship has now increased to about 47,000 tons. This is the forward order book. It tells you how many ships have been already pre-booked for long-term charters. And you can see what is the price at which they've been booked. So the yellow line, or the greenish line on the top gives you the average booking rate at which we have booked the ships. The red line gives you the total number of available days, and the black line underneath gives you the percentage of the red line that has been booked at the price which has been shown on top. And you can see, basis these two numbers, you can calculate what is the total forward commitment that we have is 258.1 million metric tons. This again gives you a snapshot. You can see it later on at your convenience of the ships sold versus the ships bought. And similarly, the ships sold and bought in the ultra space. With that, I'll hand over to Gautam, who will take you through the financials.
So thank you. So here are the highlights for our Q4. So our net profit in the quarter in Q4 was USD 10.77 million, or baht 0.23 per share. Our EBITDA was quite strong. It was USD 26.45 million. We paid also interim dividend number 3 in the amount of 10 satang on 4th of December. During the quarter, we also took delivery of 2 Ultramax vessels, which is the Usani Nari and the Urairat Nari. And we also signed an MOA to acquire 2 new building resale Ultramax vessels, Ubon Nari and Utita Nari, which we took delivery of in January. We also sold 2 handy-size bulk carriers. These are 2005 built handy-size bulk carriers, Chamchuri Nari and Nalini Nari. And we also sold 2 Supramax bulk carriers, Varisa and Varia Nari. In terms of financing, so we signed a 6 million credit facility agreement with the EO Bank. This is a Japanese bank. We signed a $50 million credit facility agreement with KfW IPEX. This is a German bank. And we signed a $52 million credit facility agreement with Bank Sinopac of Taiwan. In terms of long-term charter contracts, we had 7 ships that were under long-term time charter contracts at fixed rates, and we had 18 ships that were on long-term time charter contracts with rates linked to the underlying index for vessels of that size. So just looking at the full year picture, so for the full year, our net profit came in at USD 13 million, or baht 0.27 per share. EBITDA was USD 69.49 million. We paid 3 dividends, totaling 30 satang. During the year, we also entered into a joint venture agreement with 2 Malaysian entities. One is called Lianson Fleet Group, Bharat, and the second is M Straits Navigation. We formed the JV company Nusantara Maritime. This company's objective is to focus on owning ships in the tanker and gas sectors, which will help diversify, stabilize, and grow the company's revenue base. In addition, we purchased about 1.71 million shares in Uni Asia Group Limited. This is a Singapore-listed company which is predominantly in the dry bulk sector. We received some dividend from this investment as well. And in addition, we also purchased about 53.39 million shares of VL Enterprise. This is a Thai-listed company in the tanker space. We received a small dividend there as well. So our total shareholding in Uni Asia is about 6%, and our total shareholding in VL Enterprises is about 22%. We also formed several other subsidiaries to enable us to make the investments in the Ultramax bulk carriers, but also for future opportunities that we are considering in Malaysia particularly. So we had a share repurchase program last year in which we repurchased about almost 5% of our outstanding shares. So we bought this at an average cost of about 6.06 per share. And we had a pending litigation involving the Chayani Nari in Nigeria, and that was for that we entered into a plea bargain agreement, resulting in reduced charges and non-custodial sentences for the crew members who have safely returned to Thailand on 23rd May 2025. So during the year again, so we acquired 3 Ultramax bulk carriers, and in January we acquired a further 2 Ultramax bulk carriers. So this will take our Ultramax fleet, in particular, from 8 ships at the end of 2024 to 17 Ultramax vessels by the beginning of 2027. We also sold, as I said, a couple of handy-sized vessels and Supramax vessels. And on 13th of February, we announced the acquisition of 1 second-hand medium-range tanker vessel, which we will be taking delivery of quite soon. And during the year, we signed several other loan agreements I already mentioned. Besides the 3 that I mentioned, we also signed an agreement with Krung Thai Bank in the amount of 36.37 million, and another loan agreement with Bangkok Bank in the amount of 13.58 million. So this just gives you an overview of the ships that we've been acquiring and selling. So at the end of Q4 2026, we expect to have 45 ships in our fleet. So some key figures. So Q4, our revenues came in at $50.2 million US dollar, up from USD 44.6 million in Q3. Net profit was 10.8 million compared to USD 7.8 million in Q3. And earnings per share was 23 satang in Q4 and compared to 17 satang in Q3. Our net debt to equity ratio is quite healthy at 0.59. And the number of ships at the end of Q4 remained at 40. Just looking at 2025 key figures. So for the full year, our revenues came in at 163.2 million. That was down from 177.8 million in 2024. Net profit for the year was 13.1 million, down from 41.3 million in 2024. Earnings per share came in at 27 satang, down from 94 satang in 2024. As a result of that, return on equity was also lower, 4.47 compared to 7.42%. And our net debt to equity ratio went up as we've been acquiring ships. And so that's at 0.59 compared to 0.37 at the end of 2024. So this graph over here on the top left, it shows you the average TC rate per day per ship in our fleet. And you'll see that so Q1 and Q2 were very, very weak quarters, but we had a good recovery in Q3 and Q4. So in fact, Q4 2025 was the strongest quarter. And this is also reflected in the EBITDA. So Q4, we had the strongest EBITDA at about 26 million compared to just 8 million in Q1 of 2025. So we've been paying dividends quite consistently, as you can see. And our cash balance has remained quite healthy. At the end of Q4, we had about 40 million of cash on our balance sheet. So this over here shows you our statement of financial position. So at the end of 2024, we had about 657 million in vessels and equipment. But as I said, so we've been acquiring ships, and so that figure went up to 699 million, and it's of course projected to go up further this year as we've already taken delivery of some ships, and we are expecting to take delivery of more ships through this year. Shareholders' equity at the end of 2024 was at 496 million, came down to 475 million at the end of 2025 due to the share repurchase program, and we've been paying healthy dividends as well. Loans and debentures was at 249 million at the end of 2024, and that's moved up to 320 million at the end of 2025. So this is cash movement in Q4. We began Q4 2025 with $49 million of cash. We generated $27 million of cash from operations, capex of 75 million. This is primarily these 2 ships that we acquired. We also sold some vessels through which we generated about 18 million of cash. Finance costs during the quarter came in at about 6 million. We had loans of about 49 million. We had loan repayments and prepayments of 17 million, dividends of about 5, and we ended the quarter with 40 million. So this is throughout the full year. I'll leave this as a reference slide. Okay, so this is just long-term loans from banks. This is the loan movements. So we began the year with about 209 million. We had drawdowns totaling about 116 million, repayments of 45 million, and we ended the year at 277.8 million. And here are the undrawn loan facilities that we had at the end of 2025. This over here, we show you the operating expense per day, granular figures. So this is the figure for Q4 2025, and below this is the figure for Q3 2025. So you'll see that crew costs, these have been fairly stable. Same thing with lube oils, insurance, repairs and maintenance, stores and spares, dry dock and special survey. We had about 22 ships that underwent dry dock last year, and so the dry dock and special survey costs are more elevated than usual as a result of that. Otherwise, costs have been fairly stable, and in fact, if we compare ourselves to the industry average, we are about $700 per day below the industry average. So the industry average for the year 2025 is about 5,233. We are at about 4,500. This excludes the OPEX, dry dock and special survey costs. Now, every $100 in savings here translates to about $1 million on the bottom line. So this is quite substantial. So this is the dry dock schedule. So as I said, in 2025, we had 22 ships that underwent dry dock, but in 2026, we'll have just 10 ships that will undergo dry dock. Over here, we compare our OPEX and G&A expenses to some of our listed peers, and you'll see that our OPEX is below our listed peers, and also our G&A expenses are below our listed peers. Not only that, if you look at the EBITDA per ship that we have had in last 12 months, this is data that we have only from Q3 2020 up to Q3 2025. So we've actually outperformed our peers. So we were at $1.84 million EBITDA per ship compared to 1.67 and 1.8. This is for the Supramax and Ultramax sector. Here we show you our debt maturity profile. So we don't have in 2026 and 2027, we have more normal debt maturities, and 2028, 2029, we have a few balloons, and we have in 2029, we have one tranche of our debenture that is maturing. This over here, we show you the net debt and net debt to equity ratio. So it was at about 0.7 in 2014. It went up to about 1.1 in 2017 as we took delivery of a number of our new building vessels. Then came down all the way down to 0.3 in 2023, and since then, of course, we are in the midst of a fleet rejuvenation plan, and so it's gone up to about 0.6 at the moment. So this over here is the average OPEX and TC rates over time. The top line over here, we show you this is the average age. So you'll see that from 2005 until about 2011, our fleet was quite elderly, whereafter we embarked on a quite a large new building program, fleet renewal program, and the average age of ships in our fleet dropped to as low as 5.8 in 2016. Since then, it's been creeping up, and which is part of the reason we've embarked again on a fleet renewal program in order to arrest this increase. The red line over here shows you the average deadweight of ships in our fleet, which in 2005 was just 25,000. That's went up to about 44,000 in about 2016. And it's again moving up a little bit in 2025, it's at about 45,000. It'll go further up a little bit as we start to take delivery of more Ultramaxes this year. This dark green line shows you the TC rate per day for ships, average TC rate per day for ships in our fleet. And you'll see that so 2005 to 2009, the rates were very, very strong. And then there was a huge supply overhang due to all the ships that were ordered. That led to pressure in rates, which declined up until about 2016. And then after that, the supply pressures abated, and so rates returned to more normalized levels, or better levels for sure. So, and this line over here, the bottom, the lowest line, we show you the average operating expenses per day for ships in our fleet, which has remained fairly stable, of course, moving up with inflation. These are the dividends. So we have a policy to pay not less than 25% of net profit in dividends, which we've been doing fairly consistently. Of course, we had a gap during the very weak years in the market from 2014 until about 2020. But after that, we resumed our dividends. So these are financial highlights. I'll leave this as a reference slide. Shareholder returns. So if you were an investor in our stock at the IPO in 1993 and you held on to our stock until today, you enjoyed all the dividends, your IRR on that initial investment would be about 15.64%. Data on investor relations and ESG. I think we will, just very quickly. So Tharini Nari, this is an MR tanker that we have just recently announced an acquisition of. This is a 2006 built vessel, Japanese built, purchase price 11.1 million. So this marks our entry into the lucrative oil segment, so reducing reliance on dry bulk and establishing a dual sector revenue stream. This is something that our board has directed us to do. So this is a critical stepping stone for future expansion into the larger tanker segments and the gas carrier market. This is the first step. So we'll leave it at that and open for questions.
So we have two questions from the floor. Both have actually already been answered. The first question was someone's wanting to know about the positive and negative factors for the year 2026. I think I summarized that when I told you that world GDP growths are growing up, and at the same time, supply side is shrinking because of special surveys reducing the fleet size, as well as the EEXI slow speed, which has been mandated, removing about 3.5%. So together, about 5.6% is going to be reduced in 2025, and in 2026, roughly the same amount. So that is the factor which reduces the supply on one side, and the other side we've got demand growing because world GDP growth rates are improving and getting better every time that IMF comes up with a new report. The second question has also been answered. How many ships will go under dry docking and special surveys in 2026? Gautam has said that in one of the slides. He's shown you that 10 ships only will be going in for special surveys during 2026, compared to 22 that underwent the same amount of special surveys during 2025.
And there's another question on the.
Okay, so the first question, there's another question. What is the current day rate for MR tankers, and what is the break-even day rate for that? Also, do you plan to buy more tankers? Finally, what was the reason for PSL buying via stock last year? I'm curious if there is any knowledge synergy between that investment and your recent entry into the tanker business. Okay, so taking the last part of your question first, yes, there is knowledge synergy between these two entities that we have got. One is the VL that we are trying to get into through the share route, and then there is the MR tanker that we have bought ourselves. And the day rate for the MR tanker, it varies, but the current managers of this ship, who have been commercially running her for the last 4 or 5 years, they say that in the last year, they were averaging between $22,000 and $27,000 a day for the ship. The expected daily operating cost of the ship will be around under $6,000. And because it's a low-cost ship, there's not much of funding cost, etc. So cash break-even would be very close to that, maybe $1,000 more than that. So that is what is there.
one last question.
Should we worry about oversupply dry bulk fleet in 2026 or demand shortage due to US-China trade war and economic stagnation for China? Okay, so I think all these things are being answered as we speak. Oversupply of dry bulk ships in 2026, we don't think there will be any oversupply, as I've explained in the supply side charts, to show you that there will be a reduction due to special surveys and because of EEXI slowing down ships. The second thing you must remember is that ton-mile demand is growing quite strongly. So those are the two factors that will create that. And the trade war between US and China, I think US is the big loser in all of this. Anyways, the US Supreme Court has just recently ruled on Friday that Trump cannot apply the tariffs that he has done so far during 2025. They're all illegal according to them. They've shot it down. So he's trying to do it through another route. But I think he will find it very, very difficult to enact any further laws like this. So we think that the trade volumes will continue to grow. China is not going to export more and more to America. They're going to export less and less to America anyways. They don't want to rely on America. And we think that they're doing a good job of that. They've already reduced the dollar value of what they've exported to America by 20% last year. And I think they'll continue at that rate and slowly bring it down to almost close to zero. With that, I think we've answered all the questions.
ค่ะผู้บริหารเราก็ได้ตอบคำถามหมดนะคะแล้วก็เวลาก็หมดลงด้วยพอดีก็ขอบคุณทุกท่านที่ร่วมเข้ามาพูดคุยกันค่ะขอบคุณค่ะพบกันไตรมาสหน้าค่ะสวัสดี